you're like, shit, I'm going to take this money out to buy my first home, and my KiwiSaver, I had it in growth, is tanked. Welcome to the NZ Guide to Financial Freedom podcast. It's run by the co-founders of a free online learning platform called moneyskills.co.nz, and it has the sole mission of providing every New Zealander the opportunity to live a more fulfilling life. So let's kick into it. So I just want to do like a quick little summary of volatility and why it's an important consideration if you're going to invest, because I have it quite often, like even long time podcast listeners, even clients, where they've got an objective, it's in 5 years, 7 years, 10 years, and they're using an investment as a vehicle to achieve that objective. But the part where it gets a little confusing is around the volatility and what's the right thing that you should use for the objectives you're trying to achieve. So a general rule of thumb is anything less than 2 years, the best investment you can make is an investment in the bank. The reason being is you've got a fixed return that you can rely on. The trade-off is by having it in the bank, the real return, which is after tax, fees, and inflation, that's the real return because it takes into consideration the increasing cost of living. If you take off all that, usually what you earn at the bank is between -1 and 1, because you might have a 1% term deposit, you might have a 3% term deposit. Inflation tends to go hand in hand with how high those rates might be. So let's say, for example, now inflation 4.9%, term deposits 3%, you take off tax, brings that down to 2%. You take off inflation, so you're actually negative territory. You're losing money because the cost of living is increasing faster than what you would earn at the bank. But the good thing about the bank is that it's accessible, it's a fixed return, and it's not volatile. You're not going to go negative in the sense that you're going to get like a market crash, and then suddenly, the money that you have invested is only worth half of what you put in. But what does happen is consistently over time, the cost of living might be increasing faster than what you're earning at the bank. So that's an important distinction, is where it's not a volatility thing, it's just a low rate relative to inflation thing. So now if you get over the 2-year mark and you're going to buy a house in 3 to 5 years, or you're going to take out the money for something, you've got an objective that you want to use the money for, like maybe travel, you're going to close it. So if it's in 3 to 5 years, you'd be looking at a conservative fund. Now, what we learned before is that a balanced fund is between 50% growth assets and 50% income assets, or 60% growth assets and 40% income assets. And what we learned before is growth assets are shares and property that go up and down quite a lot. And then you've got the income portion, which is bonds and cash, that doesn't go up and down as much, but similar to the bank, that you don't necessarily get a higher return, but it's less bumpy. It's something you can rely on. So with a balanced fund, because you've got a good mix of growth and income assets, then your time horizon is longer because you've got more of a volatile asset. So with a conservative fund, you'd be looking at something that has less growth assets because you want it to be less volatile, hence what makes it more conservative. So a conservative fund might be 60% income assets and 40% growth assets, or 70%. Might even have 100% in income assets. And the reason you might choose something like that is you're thinking, okay, in 3 to 5 years, I'm going to close this portfolio completely. And if I have a high allocation to growth assets, shares, and property, and there's a big, like the bubble burst with property or share market crashes, it could crash for 3 to 4 years. It's done that before. So that part of your portfolio has gone down over 3 to 4 years. And you're like, shit, I'm going to take this money out to buy my first home, and my KiwiSaver, I had it in growth, it's tanked, and that's when I need the money. So that's when you start thinking, okay, if it's a 3 to 5 year window, you want to get a conservative fund. The trade-off is you have less volatility because you're in cash and bonds, you're in more income assets, so there's less volatility. But the trade-off is you're going to get less returns over the long run. That's why there's a lot of mistakes people are making with the KiwiSaver, is they're just sticking to a conservative fund. They're just like, yeah, I'm just going to stay in this conservative fund. It's a default fund, and they're missing out on a lot of returns in the long run. So that's why the 3 to 5 year mark, you're looking at a conservative fund. If you're going to buy a house next year, you want to try and put your KiwiSaver into either a cash fund or an income fund where it's 100%. So then it's sure you're not getting a return, but it's not going to tank as much when you go to take it out. Now, the 5 to 7 year mark is when you get into the balanced fund territory. That's where you got the 60% in growth assets or the 50% in growth assets. And there is some variation, but these are a good rule of thumb. That, there's a large portion, borderline 50-50, of it into an asset class that can go up and down significantly over time. So you'll expect, somewhere in that time it may go down or it may continue to do well over that period of time, but you don't know. So you don't want to go all growth because you're about to take the money out in 5 to 7 years. So you want a bit of exposure to growth assets, but you don't want to overdo it to the point where when you take it out, the market's tanks in a significant way. So what you might do is, for now, I'm going to buy a house in 7 years. I'm going to have an imbalanced fund, and then as I approach the time when I'm going to take it out, then I look at more of a conservative fund, and I make sure I do that not at a time when the market's tanked, because if you do that, you're basically selling what you have. So you've got a balanced fund, you've got 100 shares, you sell those shares at the price of negative 20, so you've lost 20% by selling it and changing to a conservative. So you want to do at some point leading up to the time when you're going to take the money out, when the market's done well, you're transferring it over. And you can't speculate. You don't know when it's going to do well or when it's going to do bad. It's just when there's a significant crash and it's down 30%, probably not a good time to change providers, and that's what people did in COVID. So what happened in COVID? A lot of people were in growth funds. They thought, growth is just going to continue to go up and up and up, and then suddenly the market went down by 20 to 30% and they freaked out and they changed from a growth fund to more of a conservative fund. So they basically sold at a negative 20 or 30% loss to buy new assets in a conservative fund. So that's something you think about. So, if it's 5 to 7 years, you're looking at more of a balanced portfolio. And as you approach the deadline, if you're going to close it completely, then you go more conservative because you don't want the volatility to change or tank when you need to get the money. Then the other thing is a growth fund. So a growth fund, you'd be looking at usually between 70 and 80% growth assets. So there's quite a large portion that sits in shares and property because you understand that it's going to go up and down over time. You're not going to lose your cool because you've made good investment decisions, so you're comfortable with it. So you fire and forget, you leave it for 10 years. And then it performs really well over the long run, but there might be times when it's down by 3 to 4 years. The good thing is when you're saving into it, quite often with a growth fund you would be saving, and with a balanced fund you would be spending, which I'll explain why in a moment. But usually, let's say you're saving into a growth fund because you've got a long time horizon and you want to buy these assets as many as you can so that when it gets to that point you've done well. And it's called dollar cost averaging, is in a very effective way to maximize the volatility, because we don't know when the market's going to tank. So if we save consistently, we're capturing the benefit and the negative, but on average doing well because we're buying consistently. And if you work out the numbers over time, let's say the market was $10 you could get, and then next year it was 20, and the year after that was 30, and then it was negative 20. If you do the maths and divide that by the average, you'll notice that softens things. On average, you do pretty good. So it's called dollar cost averaging. So with a growth fund, 80 to 70% is in shares and property. You're saving into it consistently, so you capture the top and bottom. So consistently you're doing well. And that means you're buying high quality assets at a lower price, depending on who your provider is. They're not all the same. But if you're comfortable with the provider that you have, then you're buying high quality assets at a lower price if it goes down. And then over time it will correct. And then once as you approach that deadline, let's say you would have a growth fund probably, from your 50s up into your 60s, because you're thinking, hey, I want this to work really hard as I lead up to retirement. So I've got it in a growth fund. I understand that can go up by 40, 50% up and down. It usually averages about a 5% return over the long run. So it can fluctuate though, so it can go up to those extremes of down by 40%, up by 40% for that year, but on average you would expect about 5% after tax and fees. And the final piece is when you're approaching 65, you're going to do slightly something different. Because you're not closing the whole portfolio, you're taking out an income. What you would change it to is more of a balanced portfolio as you approach retirement, because you're going to take out 6% of the portfolio value and use as an income for the next 25 to 30 years. So let's say there's $1 million in a growth fund, you're approaching 65, you change it to a balanced fund, being mindful not to do that during times of a huge market correction where it's negative, like we said before. And then you're changing it to a balanced fund, and then you're taking out 6%. So you got $1 million invested, changed to a balanced fund, and you're taking out $60,000 a year tax paid, and you'd expect that to last 25 to 30 years. Because the return on a balanced portfolio is 4% after tax, you're taking out 6%, which basically saying that it's growing by 4%, but you're taking out 2% more than it's growing. So over time, that money is running low until it runs out in 25 to 30 years. And the final piece is you could go aggressive or full index fund. So if you were to have a 12 plus year time horizon, you're really comfortable with risk, with volatility and it going up and down, then you might have like a passively managed index fund that's just all shares, diversified across countries, making sure not all your eggs in one basket. That can go up and down by 50% and you'd expect it to perform well. Alternatively, you could get an aggressive fund, which would be 85% plus. So if you've got 85% in growth assets like shares and property, you're looking at more of an aggressive fund in simple terms. And that can go up and down by 50%, but over the long run, you'd expect a 6% return after tax and fees for that one. So you sort of see the trade-off is, provided you're not making silly mistakes and putting all your eggs in one basket like cryptocurrency, you're not putting yourself at risk of losing your money if you've got the right provider. You're just putting yourself in the face of more volatility. And if you don't freak out and you don't sell, you don't lose money. So that's the thing. So if you've got a long time horizon, you're comfortable with it going up and down by 50%, you might look at an aggressive fund. If that's a little bit too much, you can go growth. If you're about to use it for your income and retirement, or the time horizon is 5 to 7 years, you look at balanced. If it's 3 to 5 years, you look at conservative. If that means you're going to close it, or you just can't handle ups and downs at all, so you want to minimize that and still get some return, slightly more than the bank, and you'd expect maybe a 3% return after tax and fees for that one. And then if it's less than 2 years, because you don't know when the market's going to do well or bad, it's better to have that money in your bank account. Sure, you're losing money consistently from inflation, but at least it's secure, it's there, and it won't go down by 10-20% when you need to take it out. So I think volatility is something that's quite often overlooked in investing. And we sort of assume because things have done so well, since the global financial crisis in 2008, things have just gone well except for COVID. People don't expect that to happen, but there seems to be like seasons. There's winter, summer, spring. People have greed. They get more and more and more without repercussions. Then suddenly something happens, they freak out, and then the markets take a while to recover. And you don't want that to be the moment when you need the money. So I think that it was important we talked about that, and if you thought it was valuable, if you could take the time to give us a review, more people should be given the opportunity to learn like you have now, or you probably already knew if you're a long-time listener, but it just means more people aren't going to make silly decisions with their money. And if we can have a prosperous, better society purely from our ability to create quality information, in my opinion, it varies. Sometimes it's not quality. Then it's only going to help us all grow, like a rising tides lifts all boats. So, I genuinely appreciate you listening to this and helping us build what we're building. So, thank you.